Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending Friday, July 12th, 2019. It's only about quarter after 3, but I'm going to go ahead and do the update. If not, I am going to fall asleep at my desk. The market has fallen asleep at the wheel. Indexes are trading slightly positive today, but just virtually no volatility, no price movement the last few days, and low volume everything else. So don't expect anything big to happen before the close. So let's just go ahead and do this now, and I can get on to my weekend, and you guys can get on to yours. All right, this is the SPY 60-minute chart. I had this trend line like this before, breakdown back test. You can do it like this, doesn't matter, nothing's going on here. And again, so whether you want to say it's back testing that trend line or here's a new trend line to watch, you only have a few reactions, so it's not very valid, but worth watching. And again, nothing's changed technically. You know, back here at this point we had a divergent high, we continue to diverge, and these divergences aren't even close to being taken out yet. They're still intact as they are on the daily charts on SPY, as they are on the weekly charts on SPY, the S&P 500, as they are on the monthly charts. So across the board you have these divergences that continue to build, but it's, you know, these aren't really related, have nothing to do with what's going on in the monthly, weekly charts. Those don't change, not, at least not anytime soon. These, you know, could be taken out, and I'm going to show you, we're going to just quickly review the charts here, what to watch next week, and then we're going to look at a few fundamental things. There's a pretty big earnings calendar next week, and in the next couple weeks there's also a lot of potentially market moving economic reports coming out. So I just wanted to talk on that real quick. So that's SPY, how it looks. You can replicate those trend lines. Again, if we break down as we did before, and it's not an impulsive breakdown, it continues to be on low volume like this, you don't have impulsive selling, you need to be a little skeptical of that breakdown. But there it is. I've added that alternative trend line here to this QQQ. Both those trend lines in SPY and QQQ come off the early June lows right there. And this one's pretty, you know, well defined. There's a lot of reactions. We're hugging it. Same story, divergent high, yada, yada, yada. All right, let's look at futures, and then we'll go to the earnings and the economic calendar. This is ES, the S&P 500 E-mini futures. You had this little trend line here that was broken. It led for a, you know, a little minor pullback, pushed on up, made a marginal new high, which is still a divergent high. So really nothing's changed there. And just like SPY, there's the trend line you have to watch. 1, 2, only 3 reactions right now. But that's worth watching. And I probably should have mentioned it before on QQQ and SPY for that matter, and I'll mention it here on NQ. As we zoom out a little bit, remember that the recent new high in QQQ and NQ was a breakout to new highs, so all-time highs that is, and it's been very, very lackluster, meaning not impulsive. It wasn't on high volume, and it wasn't impulsive price action. This is it right here. So you want to watch if we do get a break of this minor little uptrend line here, and this divergent high starts to play out. You want to see if we come back in, as I mentioned yesterday, you know, move back slightly under the previous highs isn't the end of the world. A lot of times breakouts that are back tested will come in and test a little bit below, take out the previous highs before moving up. So what you really want to watch right here, as I mentioned yesterday, 77.60-ish. There's a big old gap there, the top and bottom of the gap, and then I think this is a very important level that if it doesn't hold on any pullback, probably going to go lower from there. All right, so price action wise to be continued next week. Now let's talk about next week. We'll start with the economic calendar. If you come in on the site, whether you're a member or not, there's a lot of free content on the site. If you go on the main menu at the top of the site, there's a link called Resources. That'll bring you into the right side of the chart, Support Center, and down one of those boxes there, it's a bunch of links called Tools of the Trade, and there's this earnings calendar that you can find from, I believe it's briefing.com. And so what we're looking at is next week, and we have a pretty heavy economic calendar. Why I wanted to talk on this is I posted this on the site recently and made mention. There are, I believe, two things in play right now, two big things in play right now. One being the fact that the fact that Jerome Powell cut rates already, and has already made it about as clear as he could possibly. Like I said yesterday, the statements that came out the other day, the most recent Fed minutes were actually the most dovish in years, and that's not just subjective. There was an article in the Wall Street Journal that cited that. They looked at the words, the phrases, everything going back for years. So the Fed has gone full-blown dovish. They did it, and they cited, they see economic indicators, the economy rolling over, softening. They're worried about that. So now one of two things is going to happen. Either that continues, and mark my words, there's never been a point in time where if it continues to the point where we have a recession and the economic indicators continue to roll over long before they tell us we're in a recession, if that continues to be the trend, the only guarantee I'll ever give you in trading, or one of the few, is that the market will play a game of catch up to the downside. Now, the flip side of that is, and I don't have a crystal ball, if the Fed jumped the gun on the previous cut and then they're going to cut again, and they continue to, let's say we get a cut here at the July meeting, we could maybe get another cut next month, and the recent weakness in the economy, both U.S. and global, a lot of the overseas economies too having some issues, if that proves to be transitory, or just a brief aberration. We've seen that before. We saw that back in 2015. We had a similar correction back then. If that's the case and the economy picks back up, those indicators all start turning back up, or most of those do, now you have a situation where you may see a blow off top of the market, because you have both the economy getting back on track, and now you had the Fed that jumped the gun and gave this market extra juice, a little shot of adrenaline when it didn't need it. So I don't know which one's going to pan out. Now, where I'm going with that is next week and the following week will be pretty telling, both with earnings and the economic calendar. So while the charts are, boring right now, they may perk up anytime now. So like I said, if they do, I'll do an update. I'll do an update on Monday no matter what. And then if we continue to slow grind around on low volatility, I'll probably just pare back to every other day or so. But here's the big ones to watch. We have retail sales, always a big one right there. Retail sales, consumer spending accounts for roughly 2/3 of GDP. So that's huge. That is more important than anything. In other words, retail sales dwarfs government spending. As much as government spending is, it's the consumer that drives the economy. Industrial production, 915. There's a big one too. Housing starts. As I told you, there's three pillars that are keeping this stock market and this rally, the bull market, afloat. That is consumer spending and confidence. As I said, they go hand in hand. It is the housing market, which also plays into that. It's all about the consumer, really. But then those three pillars under the consumer, you have the housing market and stock market and job market. So those are the three pillars that are driving, keeping the consumer spending, keeping them pumping money into their 401ks and things like that. Again, the job market, which we know is strong, it's at record lows, or I'm sorry, unemployment is, but it's also at the same levels historically that it's been when it bottomed. So, it's a matter of when does that turn. So we're watching that closely, watching the employment data closely. Housing market, as I said, housing is a large portion, in fact, for the middle class, other than the uber wealthy. The uber wealthy, the majority of their money is in the stock market. But for the majority of Americans that have money in the market, you have the have-nots. They don't even have enough, for the most part. I'm generalizing, of course. They're just trying to get by, paycheck to paycheck. They're not pumping 401ks full of money. Most of them don't own stocks. So then you have the middle class that represents the bulk of the money in the market, and a lot of Americans, the bulk of their net worth is in their home. So I'm watching the housing market closely. Seeing some things, indicators turning down there. If that trend continues, once that goes and your home values start to go down, you lose confidence. So there's one pillar there. As I said, the job market, obviously, and then it all comes in together with the stock market. The stock market is up, doing well at all-time highs. Consumer confidence is high because, again, those that are spending the most and have the money in the stock market, they're happy. So, like I said, they're interrelated. Don't get me wrong, but sometimes you can maybe pick up on some clues. If we start to see the housing market roll over or the job market roll over, stock market will not be far behind. That's almost guaranteed. So crude oil, that's not a giant, a huge economic indicator, but it is important because it determines the energy sector, a lot of other things there. So we'll watch crude prices. Of course, there it is. Jobless claims, a big one, and the Philly Fed Business Outlook survey. So that's all coming out next week, and then the following week we have existing home sales, once again, new home sales. So a lot on the housing market next week. Durable goods, always a big one. That's a key report right there to watch. And of course, jobless claims, and then the all-important GDP. That's what it's all about. This is what recessions are measured by. Two contracting quarters of GDP. So we'll watch GDP, and that's a big one as well. So that's all coming up in the next couple of weeks. And right now, with we know where the Fed's thinking and their mindset, so that's all out of the way. So this is what we'll watch coming up in the next couple of weeks here. Oh, and of course, I didn't mention it, but the following week on Wednesday, July 31st, the last day of the month, the Fed wraps up their next announcement. We already know at least a quarter point cut is baked in the cake. That's Wednesday, July 31st at 2 o'clock. But next week, and that's way out there, so we'll see. And we already, again, we know what happens, but again, then it's what the Fed comes out and says afterwards. Plus, they're going to have an extra couple weeks data in addition to what whatever Powell said earlier this week. All right. So next week, again, on the site, under resources on the main menu, go into the support center. Under tools of the trade, there's a link to the earnings calendar. A member of the site posted this one, Trident ES. It's a nice visual, so you can see the company's logos. These are all on the deck for next week. So in addition to some potential market-moving economic reports, you have some big names reporting. Big trucking company, big banks right here. A lot of big banks, J.P. Morgan, again, railroads. So this is going to move the transportation sector. There's airlines. So these are the sectors you're going to see move next week. Transportation, financials. Netflix is a big one. I commented on that for members recently. There's certainly a trade set up there right now. There's Bank of America. You get the picture. So a lot of financials coming out next week. There's one of the big fangs right there, Microsoft. And another big financial right there. So a lot of stuff on deck next week, both earnings-wise and with economic reports. So my guess, based on that, we'll start to see volatility at least perk up a little bit. Going back to the chart of the S&P 500 here, or SPY, you look at a daily chart. And here's what I'm talking about. You can see these candles. Look how tight the trading range has been for the last few days. Real tight, with volumes dropping off there. Another very low volume day today, which might be the lowest of the year. Look at that. If I put a horizontal line there, we're not, markets haven't closed yet. There's a half hour to go in the trading day, and you always see a surge in volume right towards the end of the day. But either way, you can see as I'm putting the crosshairs here, just going back all the way to the beginning of the year. This may end up being the lowest volume trading day of the year. So that's what we'll watch next week, and we'll pick it up from there. Have a great weekend. This has been Randy Finney with Right Side of the Chart.